Welcome, everybody, to this week's Middle Class Investor. Thanks for coming in. Well, listen, last week we talked about bearish divergences and the heavy selling that took place the week before. We talked about how that could continue, especially given the bearish divergence we were looking at. I think what I want to talk about this week really is. We're still going to show the charts, but I'm in the background I'm going to talk about the psychology, because the market goes up so much of the time that the psychology is that, and even the quote unquote professionals that you meet at Edward Jones, and some of these guys are really good. I don't want to knock these guys. I mean, they're professionals, but the psychology is such that the market goes up 90% of the time. It goes up according to mood. As mood elevates, market goes up. But when it sells off, it sells off in a very different way. And a lot of times that psychology that lifted the market continues. In other words, people don't change the way they think about the market. They just convince themselves that, well, I'm in it for the long haul, and it'll be okay. And of course, what you end up there with is regrets. I should have sold. I did. Should have done this. Should have done that. And the problem is there's no do-overs on that kind of stuff. So you have to be aware of that psychology, and you have to operate with it in the background. You have to still be able to make decisions, even though that's going on in your head. And it's very, very difficult. I don't want to make it sound like it's easy. A lot of people try to, trade and invest in the financial markets, and a lot of them give up in despair. In fact, the vast majority, more than 90%, give up in despair and just say, well, that's not for me. I can't do it. And turn it over to somebody that they think can, but and that person has the same psychology. I mean, we're all human beings. We all operate, our minds all operate the same way. And what you have to learn how to do is you have to learn how to think in terms of probability. Given that this has happened, what's likely to happen? Or if this does happen, what do I need to do to react to that? So somehow you got to arrive at a decision, but your plan has to be more probabilistic in nature. So we're going to talk a little bit about that in the background of looking at these charts. And hopefully that'll help. I mean, that, again, even in the professional world, the professional investing world, the person that actually trades the money and the person that does the analysis work, these are two different people. So in the professional world, they separate the people who are making the decisions and the people who are acting on the decisions. And so when you take something that even the professionals feel like they need to separate, and you try to collapse that all into one mind, it becomes difficult, and you just need to know that. So, all right. So what we're looking at is the S&P 500, the selling that we had the week before. The volatility was very, very low. I mean, we had 18 weeks of very, very low volatility or something like that. And the week before, of course, doesn't look like heavy selling on this chart in the context of last week. But this was actually pretty heavy selling given the week, the doji that we had the week before, and then this run up, this kind of run up. And then we had this doji, and then when you get something like this is kind of called, this combination of two candles it's a dark cloud cover or a bearish harami, and the way they're confirmed is the third candle is a down candle. So this, in fact, was a bearish harami or a dark cloud cover, and it was confirmed by this past week. So again, we had heavy selling here, but it just, now looking back at it, this doesn't look like such heavy selling given this, okay? But this was heavy selling. The volume was up. There was a lot of complacency. People were bullet. This was buy the dip. Oh, we're just dipping here, and it's going to go up higher. So again, we were talking about probabilities a second ago. So given that volatility is very low, we talked about this bearish divergence where you had the peak of momentum was back here in January, February. We made a new high here or here, but on lower momentum. So that should give you some heads up, okay? So this is a probability factor for the downside, okay? The fact that we had a doji and what could be a bearish harami or a dark cloud cover, depending on what you want to call it, that could have been a heads up. So immediately you have to start thinking again in terms of probabilities and what's likely to happen given that volatility has been going down the whole time. We've been going up. We get this bearish divergence happening. We had some heavy selling over a doji. These are all factors. Dave Johnson, a guy that I trained under, he used to talk about the weight of the evidence. So when you're evaluating the market and you're trying to develop a plan on what you're going to do, you need to look at the weight of the evidence. And so the weight of the evidence was, probably next week's going to be down. That's what we were thinking last week. Probably next week's going to be down. But it's a probability. It's not a for sure thing. So when you're looking at this, and you're looking at this bearish divergence, this peak here that happened back here, and then we got a new high, but we got the market rolling over. Well, probabilistically, you're thinking we're going to have at least some sort of pullback. Okay, so I need to get ready for it. I need to think about what am I going to do, if anything. Maybe I do nothing, but I decide that up front. That's the key. So, all right. So that's the S&P 500. Let's talk about, before we leave the S&P 500, let's just talk about where things are likely to go. Okay, as long as we're talking about probability. First, let's back up. Let's back up a little bit. Let me get rid of this, of these studies down here, because it compresses the price action, makes it harder to see what we're looking at. So let me zoom out a little bit, and I'll zoom back in. But there we go. So if this was a wave 4, if we peaked here in wave 3, wave 4, and this has all been a wave 5, well, what do we know? We know that the market usually returns to the wave 4 low before bouncing. Now the question is, which wave 4? There's a wave 4 here. There's a larger degree wave 4 here. Well, both are correct, but what you have to think about is what your time horizon is. And I would say if you're in a 401k, your time horizon is more like this one. But let me tell you what I think, my experience is we'll probably bounce to this wave 4. So I'm going to go ahead and mark it on the screen, and I'm going to tell you why. We'll probably bounce to this wave 4. We'll sell off to this wave 4 and then bounce. And then we'll probably blow right through this wave 4. Okay, so this wave 4 is not going to be support, more than likely. And I'll tell you why. First of all, the channel, once it's broken, and it was broken pretty convincingly. Of course, we rallied back up above, but I think we're going to sell off further down into this area. And then we'll probably rally back up into the bottom of this channel. It may take a week and a half or something like that, given how far this is, maybe 2 weeks, how far this has come and how fast. We may rally for 2 weeks back up into the bottom of this channel. And then when we sell off the next time, it's going to blow right through this wave 4. That's my guess. Okay, that's what I'm looking for. Okay, so when I look at this market, and let's say I'm in my 401k. Well, there's still a lot of bullishness, so I'm not worried so much about the market just crashing right here. But I'm going to have to take a little bit more pain. I'm going to have to, if I'm somebody who turns on my computer and looks at my account balance, it's going to be painful, when this comes down to here and I'm looking at it going, you need to understand there's some psychology involved in making that decision to wait to here and then wait for the bounce to do something. And that psychology is, I should have gone ahead and sold. I didn't. Nah. And of course, maybe you should. Maybe you should just go ahead and sell right here. But the way the wave system works, the wave principle works. We haven't had a full 5 waves down. We've had the starting of a wave 4, which is likely mean there's going to be a wave 5, and it makes total sense from a probability standpoint that once you get to support here, that you get some sort of pullback to the bottom of this channel. In fact, let's just measure it. Let's just suppose, just for a second here, and there we go. Couldn't zoom out. Let's just suppose that we pull down to this yellow box here. And I'm going to do a Fibonacci, and I'm going to see what the Fibonacci would be back up to this channel. Okay? I'm going to show you how you can actually use some of these tools to help you make better decisions. So I'm just going to put it in the middle of that box. And that box was not scientifically drawn or anything like that. Actually, I'm just going to put it at the beginning of the box. It's not scientifically drawn or anything like that. It was just put up there based on this wave 4 low. Okay? So I'm going to say we're going to go down to that yellow box right there. Okay? Now, look at this spot right here. See this spot right here? That's a 62% retracement. Okay? Now, doesn't it make sense that I complete wave 5, around here, and then I start some sort of wave 2 back up into the bottom of the channel, and then that happens probably around election time. I think our elections are in 3 weeks or something like that. So I said it would take maybe 2 weeks to get up there, but it could take 3. Okay, it takes 3. And I don't know what's going to happen in the election. I don't think the market knows what's going to happen in the election. But it's a catalyst for a turn in the market. Okay, so something happens in the election. The Republicans win big. Market sells off. The Democrats win big. The market sells off. What I'm telling you is the market's going to sell off regardless of what's going to happen there. But that'll be the catalyst for the turn. Potentially. We're just talking in terms of probabilities here. Now, you don't go out and you don't go blabbing to people, this is going to happen like it's going to happen. No, if I'm giving that impression, I want to make sure I back away from that because I don't know that that's going to happen. But what I'm looking at, the weight of the evidence is, in fact, let me pull back and look at a daily chart. If a daily is far enough back, these waves, yeah, okay. So let's look at a daily chart here. Let me zoom in. Let me show you what I see. I see a wave 1. I see a wave 2. I see a wave 3 all the way down to here. And I see 4 probably ending somewhere around where it is right now. Okay. I mean, in fact, the market could just sell off immediately on Monday. And then I see a wave 5 down into here. Okay. And then I see a move to there because off the previous wave 4, we'd generally go there. We'll go there very quickly. We might have something like this in between, and then a 5-wave move up into here. See, this would be 1, and this would be 2. So, to me, this is very plausible. It's a plan. Now, does it have to work out this way? No, it could work out some other way. But this is what I'm expecting to see. Now, if it gets here and just blows through this box, then okay, we'll have to make a decision. I'm maybe not going to get a retracement in wave 2. Do I take my lumps here, or do I wait a little longer? That's part of the decision-making process you have to make. It's very, very uncomfortable, and having to make decisions in the face of uncertainty is something that most people don't do, and it's an uncomfortable situation. But you have to make decisions. You have to be okay with the decision you made, and then you step back in and you reevaluate, when more information comes out. So, but can you see that from a weight of the evidence standpoint, people are still bullish right here. So, in order to get rid of that last, group of bulls, maybe we rally a little bit and then sell off hard and just crush their hopes and dreams. And then about the time they're like, God, that's it, I think this is going lower, then it rallies and goes back up. Okay. The market has a knack for doing just the opposite of what the majority of the people feel like it's going to do. So, right now, a lot of people think, this is a V bottom. They're talking V bottom. We're going to get a bounce. We'll probably get a little bounce and then just a sell off. Maybe a bounce at the open, and then before 10 o'clock, this thing's selling off and going down here toward this box. So that's kind of what I'm looking for to happen. Now, maybe it happens, maybe it doesn't, but that's my posture, if you will, coming into next week. And I'm going to react accordingly. Okay, I'm going to act based on that posture. Take action. So I would encourage everybody to think, try to start thinking along the same lines. Think about, okay, what's likely to happen. I've got my golly, I'm having trouble. I've got my channel. Of course, I took the stuff off, but I've got my channel drawn. I broke the channel last week, so it's likely we get a little bit more sell-off. We retest the channel, and then it's lights out down to here, probably 1,800 on the S&P, 18,000 on the Dow, and it's going to be interesting. All right, so we spent a lot of time on the S&P. Let's look at volatility. We'll look at and see how volatility expanded last week, which we talked about that potentially happening. We were down here. Of course, it expanded all the way up here, and then as the market rallied, it sold off a little bit. So let's go back to a weekly. Well, I guess I have to do that. Okay, so last year we were down here, and we talked about it probably expanding, breaking out of this range, which it did. Okay, we had this lower part of the range, we had this upper part of the range, and it broke out of the range. All right, let's look at a lot of talk of the Fed. You're starting to get Trump is starting to attack the Fed, which is kind of interesting. Trump, I think, understands. First of all, he's in the real estate business. A cornerstone of the real estate business is the interest rate. Okay, so Trump clearly understands that the country has a lot of debt, and that most of it is financed. Let's put it this way: the average duration, the finance on our national debt is like 5 years. So, if interest rates spike, obviously servicing that debt. Forget about paying back the debt. The debt's not going to get paid back. We're either going to default on it or they're going to inflate it away, but it's not going to get paid back. But the fact remains that servicing the debt, paying back the debt is an impossibility. Okay, but as interest rates rise, we start approaching the impossibility of even servicing the debt. In other words, just paying interest on the debt. Forget about paying it back. That ain't going to happen. Never going to happen. Okay? But what's going to happen, and I think what Trump realizes, is that even servicing the debt just hanging on by paying the interest payments is going to become an impossibility, given the size of the debt, the trajectory of interest rates, and so on and so forth. So, Trump is doing what Trump does. He's attacking the Fed. He says the Fed is crazy. They're el loco. Because he's a politician. He's trying to get Republicans elected. He also sees that if Democrats get elected, he might be impeached. They might try to put in all kinds of socialist, disastrous policies. There's just, in his mind, all kinds of bad things are going to happen if Democrats get elected. And maybe they will. I don't know. There's no way to know that. Certainly, there's a lot of crazy stuff going on, politically. I mean, I think anybody can see that. You don't have to be a political strategist to understand that, the Democrats appear to have lost their mind, and they're trying anything and everything to disrupt Trump, even to the point of using the government to do it, which I think is appalling and scary. And then you got Trump, who's fearless in this media world, and he's just calling them out, and he's wreaking havoc on their side. So it's definitely a crazy political time. But one of the things that's starting to come to the forefront for Trump, I believe, is this debt situation and servicing the debt and this increasing interest rates. I think he sees, and he's probably right, that this could wreck his entire presidency, among other things. I mean, this could financially wreck his presidency. So he's starting to lash out at the Fed, and it doesn't matter. It's not going to do any good, because the Fed they don't control the market rate. So that's the easiest way to say it. The Fed does not control the market interest rate at any duration. I don't care if it's the 13-week, the 6-month, the 2-year, the 5-year, the 10-year, the 30-year. None of those interest rates are controlled by the Federal Reserve. Only the overnight lending rate between banks is the only rate that's controlled by the Fed. And even that rate is a suggestion. It's not even a requirement. So if JP Morgan wanted to borrow money from Morgan Stanley tomorrow, and the Fed's fund rate was 1.75, Morgan Stanley could say, JP Morgan, we don't like your balance sheet. It looks very risky for us to loan to you at 1.75. We want 2.5. I mean, they could do that. There's nothing stopping the banks from demanding higher interest rates than the Fed is setting the target rate at. So the Fed really does nothing. They do nothing. Now, they do have, all this monetary policy around, quantitative easing and things like that. That is something. That's very different. But as far as interest rates, the Fed follows rates. They follow, as long as this continues to go up, the Fed's going to continue to raise rates. There's no way the Fed is going to let the 10-year, this rate right here, go to 5, 6, 7% while lowering the Fed funds rate. No way that's going to happen. They're just going to keep raising. They're going to follow this 10-year to the moon if it goes to the moon. Okay? If they don't, they're going to lose all credibility. People are going to start going, well, what's the Fed doing? Why are they lowering rates when the market rate is going up? People are going to start figuring out that the Fed really doesn't do anything. And then they're going to start saying, well, what's the Fed for? Why do we have the Fed? It looks like they're doing more damage than they are good. And there's going to be a whole conversation about the Fed. And they don't want that to happen. So they're going to keep raising rates as long as the market rates keep going up. And the market rates are going to keep going up because of the debt and the deficits, not just the government deficits, but the trade deficits and the whole lot. I mean, we are living pretty much on borrowed time. So as long as that living on borrowed time continues, you're going to see the Fed You're going to see the interest rates go up. You're going to see the Fed follow those rates. So hopefully that will bring a little. I don't know if that makes you feel comfortable or not, but at least knowing, kind of what's going on there can give you a little comfort, maybe. All right. Let's look at the Dow. The Dow, what's interesting is I really thought this would go probably higher in a wave 5. Of course, we still had 5 waves in this wave 5, but it didn't go very high. And I just thought that was interesting. That just shows you how weak the market is and how it really wants to go lower, probably significantly lower. But all right, let's look at some of the other countries. We talked about Germany last week. We talked about let me do it like this. We talked about as long as it was inside this channel, this was maybe a pullback. But, we got a gap right here. This thing is probably going right through this channel, in which case this is a top. So let's just, for now, since the U.S. market is sold off, let's just, from a probability standpoint, let's say the weight of the evidence is for this to break out of the channel. Now, once it does, again, we'll get some sort of retest, probably to the bottom of the channel or up in the channel a little bit, and then more selling. But this is key right here, this whole break of this channel. If that happens, then that is reality. Okay, top. Same thing with these other markets. Japan. Again, Japan is in the channel. Markets tend to correct inside channels, and they tend to go in the direction outside channels. So right now, this looks like a pullback and an uptrend, but if it breaks down through here, then this is a top. Okay, starting to see the pattern, see how this works. Hopefully that helps you better understand the way. There we go. The way these pullbacks and stuff work. Now you can see. I don't have the right channel drawn here, but I guess I could draw it on there real fast. This is Great Britain. So Great Britain still inside the channel, barely. Same story. If it breaks down through this, then this is likely a top. The reality is, I think the whole world, it's not just the U.S. that has a lot of debt. China now, China actually has more debt than we do. And you got, people have been talking about it for years, but you got these empty cities over there. You've had these all wise, all knowing, government officials try to lead the economy over there. And, to the extent they haven't been able to do it, okay? Because if they were successful, people would be living in those cities, and people would be productively employed doing something. The problem is they're not. So that's how you know that that's some sort of that's less capitalistic and more like communism. That's like Soviet commissars deciding, we need a city here, and as long as we have people employed building stuff, that's good for the economy. Well, yeah, but at some point, it's got to sustain itself. It's got to be self-sustaining. There have to be people working in it, maintaining it, doing something productive in it that leads to, greater economic activity. It can't just, once you build it, now all the construction guys leave, it's just standing there rotting. That's not capitalism. That's communism. That's what that is. So China has spent a ton of money, directed money into this segment of their economy, and it's going to be disastrous. Once these debts start defaulting, and I mean, I don't even know who owns all this stuff, but they definitely borrowed money to do it. So somebody somewhere owns the debt. It could just be the banks, which are then maybe owned by the government or something. I don't know, but it's all a bunch of it's a kind of a circular economic thing where the government's in the middle, and they have the appearance of people. There's a bank that loans money to a construction company, which does this, which does that, but at the center of it is the government. And there's no real. The losses are just borne by the taxpayers somehow. So anyway, that's crazy stuff going on in China. But there's debt all over the world. Europe has tons of debt. I mean, I think the dollar-denominated debt in the world right now. This is legitimate debt. Okay, this is not off-balance sheet debt. Is over $100 trillion, and there's just not enough economic activity to sustain it. So it's probably going to get written down, and a lot of people are going to go bankrupt, and a lot of people are going to lose jobs and all kinds of stuff until it all gets rearranged properly in the marketplace according to what consumers want and what people need, not what governments want and governments need. So it's going to be exciting. Just a barrel of monkeys. Probably haven't seen anything since the 20s and 30s. So, hopefully we're all prepared. All right, let's switch over to the toss charts, and let's look at gold. Gold had we've been talking about gold should be breaking out soon. It's been chopping around, really hadn't done anything. But last week gold really, poked its head up. And I think that's probably a good sign for gold moving all the way up into this area up here. Again, I don't know it's hard to say what gold is doing. It's, but I think the bullish direction is the more probable direction over the next 18 months or so. And then, or 12 to 18 months. And then we'll look at, gold again and try to identify where it's about to turn and try to, get decent prices on it to then short it. One of the things I look at is the GDXJ. This is the junior gold miners. I'm looking at, again, this is what I'm doing. I mean, you don't have to do this. I'm not advising you to do this, but I'm looking at probably these miners moving up into this $60 area, or maybe $55 area, and from 29, that's a pretty good run. So you can look at that if you're so inclined. We broke below this line, kind of a flush. Anytime I see something like this where there's a line and there, keeps going to the line and rally, keeps going to the line and rally, but it's getting narrower and narrower, it's probably going to break through, but that's going to be like the flush. And these are good areas. These are good prices to buy right in here. So, and I'd look forward to, like I said, get up above this 52 area, probably around 55 before you need to think about selling something in the GDXJ. All right. Let's go to the euro. Euro, I've been trading that a lot. I'm expecting the euro to get up above this area here, which is 1.25. It may or may not. I'm sorry. I said that wrong. I was looking at the wrong peak. I'm actually looking to get up into this area here around 1.186. So I'm looking at trading the euro up here. I'm in this position, full disclosure, already. If it rolls over and comes down, I'll probably sell. But if it continues to move like it looks like it wants to, probably trade it all the way up here into this 1.1867 area. And then at that time, look for something to go short on the euro, something below this point right here at 1.123, 1.1293. So that's what I see on the euro. Oil looks like it's, it's probably going to do something like this. Maybe I don't know. Anytime it goes this high on the first move up, it's likely, the first leg of a triangle. So what'll happen is these legs will get smaller and smaller until you get to here, and then probably make a new low. But oil might need to consolidate some because of this sell-off was pretty rapid through here. And this was the fourth wave low, so we went past that, but we didn't go past it in the first move. So that's why I'm thinking this is probably going to be a triangle, but who knows? I don't really know. It could just come down to here and then rally slightly higher. Like it could come down to this box or even shorter, somewhere in here, and then rally somewhere up here around 85 and then sell off. But I think for the short term to intermediate term, oil is trying to make a top here and roll over and start coming down in some manner. It's hard to say right now, but I certainly wouldn't be long oil stocks or oil right now. I think commodities in general, even though they're moving up, we've talked about this with gold and silver, the commodities are as a whole, there's going to be one more big flush on commodities, and it's probably several years from now. So there's going to be a lot of going up and going down before that happens. So, but and maybe in oil's case, it's 3 or 4 or 5 years. If we go sideways in a triangle. All right. I guess that's about it. We can look at the NASDAQ. The NASDAQ selling off hard. These are weekly charts. I look at a 4-month or 4-hour. You can kind of see the wave principle here. Kind of a 1, 2, 3, 4, and then 5 will be lower. Or maybe this is complete. Maybe it was 1, 2, 3 here, 4, and then 5. NASDAQ could be complete. I'm not sure. But anyway, there's probably more selling coming, but let's go back. Let me end with the S&P 500 because I think it's a good market to follow, and we follow it here. So just as a reminder, I'm looking for this to break lower down in this area and then rally back up to the 62% retracement around 28.25 or so, 28. I'd say between 28.15 and 28.30, and then before we sell off again. So if you're still in your 401k and you want to try to, cobble together a plan to get out, but get out at better prices, you might try that plan. All right. Listen, everybody, thanks for coming in this week, and we'll talk to you next week. Bye-bye.